Hey everyone, it's Tony Leonardi, your certified financial planner professional from Newtown, Connecticut, and author of A Smarter Way to Retire. Back with another episode of A Smarter Way to Retire. Over the past few weeks, we've been building a framework for how to think more intentionally about your retirement money. We started by separating your live-on assets from your leave-on assets and created two buckets. Then we expanded that framework into a 3-bucket approach by adding the early retirement income bucket to help manage sequence of returns risk, which, as you know, is one of the largest risks you face early on in retirement. Last week, we talked about how to fund those 3 buckets in a more tax-aware manner. Today, I want to take you to the next logical step. How should you actually invest the money inside each of those 3 buckets? Because once you've decided how much money belongs in each bucket and where that money is going to come from, the next logical question is always the same. What should I invest in those buckets? What should my investment mix look like inside of each bucket? So I want to be clear up front. Today, we're going to keep this discussion high level. I'm not making any specific investment recommendations in this episode. The right investment mix for you and for your 3 buckets will depend on your individual situation, your risk tolerance, your time horizon, and your overall plan. Any actual investment decision should be made as part of a coordinated, comprehensive strategy put together by you and your advisor. With that in mind, let's walk through how we generally think about the role of each bucket and how to invest our assets in each bucket. One of the biggest mistakes I still see people making is treating all their retirement money the same way, as one nest egg. People often default to a single investment strategy or a single allocation, sometimes like a 60-40 or 70-30, and apply that across their entire portfolio. That approach ignores the fact that different dollars have different jobs and different time horizons. In addition, I still see many investors in retirement focus primarily on which stocks they should own, with relatively little thought put into true asset allocation. It's important to remember that investing in retirement is not the same game as investing for retirement. Once you start drawing income from your portfolio, you need to be much more aware of volatility, income production, and cash flow, not just long-term growth. This is exactly why my 3-bucket framework can be so useful. It gives us a clearer way to match investment strategy to the actual job each portion of your money is meant to do. So let's walk through each bucket one at a time. Bucket 1 is the early retirement income bucket. This is your short-term bucket, the money you set aside to cover the first 3 to 5 years of retirement spending, or the next 3 to 5 years of retirement spending if you're currently retired. Its primary job is not growth. Its primary job is availability and stability. Because this money will be spent relatively soon, and because its purpose is to help to protect you from having to sell investments during a market decline, it should generally be invested more conservatively. Typical holdings in this bucket might include cash or cash alternatives, short-term bonds or bond funds, high-quality intermediate fixed income, possibly some laddered CDs or treasury securities. Nice, safe stuff. The goal here is to reduce the chance that a significant market drop forces you to sell at a loss just to cover your living expenses. This bucket is intentionally less aggressive so that the other 2 buckets, which we'll talk about in a minute, they have time to recover if the market declines early in retirement. This is where your income will come from for the next 3 to 5 years of retirement, or again, the next 3 to 5 years of retirement if you're currently retired. Steady, conservative, and safe are the goals of bucket number 1. Bucket number 2 is the longer-term live-on bucket. This is the money you'll use to live on. This bucket holds the money that you expect to spend later in retirement after the first 3 to 5 years. Now, depending on your age and your life expectancy, this could be a fairly long-term investment bucket. For some, this bucket will take you from, let's say, year 6 to and through years 20. 25, maybe 30. Because bucket 2 has a longer term time horizon, it can take on more investment risk than bucket number 1, while still remaining part of your overall spending plan. This is often where a more balanced or moderate growth-oriented allocation makes sense. You're still trying to outpace inflation over time, but you're not aiming for maximum growth the way you might with your pure legacy bucket. A common approach here is a mix of stocks and bonds that reflects a medium to long-term time horizon. Again, the exact mix will depend on your overall situation, your risk tolerance, other income sources, how much income you need to generate from this bucket to complement those other sources, such as Social Security and or pensions if you have them, and how much flexibility you have in your spending. How much spending is needs versus wants? That will make a big difference here as well. The key distinction here is that this money still has a job to do during your lifetime, so it needs to balance growth with some degree of stability. Bucket 3 is your leave-on bucket. This is the money that you intend to pass on to your children or grandchildren, either intentionally or whatever's left over. In most cases, this money has the longest time horizon of the 3 buckets. You may not touch this money for 25, 30, 35 plus years, in some cases, maybe even longer. And then remember, your kids and grandkids have long life expectancies as well, so you may want to add that to your time horizon. Because of that longer term time horizon, this bucket can often support a higher allocation to growth-oriented investments. Stock investments. This may be where you want to own your individual stocks. The primary goal here is long-term appreciation rather than near-term stability or income generation. That said, even your leave-on money should still be diversified and aligned with your overall risk comfort. A longer time horizon does not mean taking unnecessary or concentrated risk. It simply means that this money can generally afford more volatility than the money that you'll need for the next few years. Here are a few important principles to keep in mind as you think about investing in your 3 buckets. First, time horizon should drive risk more than age alone. 2 people who are the very same age can have very different investment needs and different investment strategies depending on how much of their money is truly live on versus leave on. Second, these buckets are not static. As you move through retirement, money will shift. What was once in bucket 2 may eventually need to move closer to bucket 1 as it approaches that spending window. Some people like the idea of regularly refilling bucket number 1 so that they always have the next 3 to 5 years of income essentially, quote, in the bank. Regular reviews with your advisor will help keep the structure aligned and within your actual needs and spending timeline. Third, tax location still matters. Where possible, it can be more efficient to hold certain types of investments in certain account types. That coordination between investment selection and account type is one of the reasons a comprehensive retirement model is so useful. I'd also like here to highlight a few common mistakes I see when people start to invest in this multi-bucket approach. Number 1 is making bucket 1 too aggressive and then being forced to sell during a downturn. That's what we're trying to avoid with bucket number 1. Second mistake is making bucket 3 too conservative simply because the overall portfolio feels safer that way. Now, if your risk tolerance is very low, your bucket 3 might not be as aggressive as your neighbors, but because it's a longer term time horizon, you can afford a little bit more volatility in your long-term legacy bucket. Still a big mistake I see, investors treating the entire portfolio as one allocation instead of matching risk to time frame and purpose. Another mistake is setting the buckets once and never reviewing them again. This 3-bucket structure works best when it remains intentional and is reviewed periodically. This is also where financial modeling becomes especially valuable. When you can stress test different allocations across the 3 buckets, you can see how changes in investment mix affect your probability of success. sequence of returns risk, and what may ultimately be left for your heirs. The goal is not to find the perfect allocation. The goal is to find an allocation that is consistent with the job each bucket is meant to do. If you've taken my Smart Retirement Strategy quiz on my website, the results can give you a useful starting point for thinking about how much emphasis to place on each bucket and how growth-oriented each bucket might be. This quiz helps you identify whether your situation leans more towards live-on priorities or leave-on priorities, which in turn influences investment decisions. My Roth IRA conversion playbook and my Smart Tax Shield Legacy playbook can also be helpful companions here, because investment decisions and tax decisions are closely connected when you're funding and managing these three buckets. If you'd like help determining appropriate investment approaches for each of your three buckets based on your actual numbers, I'm currently offering to build a smart retirement model for you at no cost or obligation while time slots are available. The model can help illustrate how different allocations across the buckets may affect your overall plan and what type of effects, positive or negative, they'll have on your family. You can book a short 15-minute call on my calendar at leonardifamilywealthcare.com. You can also take my free Smart Retirement Strategy quiz on my website if you haven't already. Thanks for listening. Remember, there really is a smarter way to retire, and a big part of that is making sure the money in each of your three buckets is invested according to the job that it's meant to do. Have a great week, and I'll see you next week.
Securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA SIPC. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. The opinions expressed herein are for general information only and is not necessarily the opinions of Osaic Wealth or its representatives. Investing is subject to risk, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regard to your individual situation.